As promised, we're back. Fin Chapter 7, homework number 6, ratings, interest rates, and the yield curve. What is a bond rating, and what effect does it have on the interest cost of the issuer? Private companies, these are private companies. I wish they weren't called agencies, but they are. But they're called agencies, but they're not agencies, they're private companies. They're called rating agencies, are paid by the issuers of bonds. These are governments and companies that want to borrow money to assess the financial strength of the issuers and the likelihood that interest and principal will be paid to bondholders. It is the job of a rating agency to assess risk. The stronger the issuer, the higher the rating. The higher the rating, the lower the coupon rate needs to be on the bond. Risk return. A high rating means a company is very strong financially, means there's very low risk, means there'll be a lower interest cost, and vice versa. Question number 2. What are the 2 reasons why the U.S. bond market has a larger market value than the U.S. stock market? First, there are more issuers of bonds. As we said in homework 5, the federal government, federal agencies, state governments, local county governments, city governments all issue bonds. And so there are a lot more bonds out there. And each issuer of bonds typically does more than one bond issue. They do more bond issues than they do stock issues. Okay? So there are more bonds outstanding than there are stocks outstanding, and that's why the bond market is worth more than the stock market. All right, a U.S. Treasury is quoted at 99.5 to 99.6 U.S. Treasury bond. What dollar price will you receive if you want to sell the bond? What is this price called? All right, first, every security has 2 prices, a bid and an ask. The bid is lower than the ask. If you own a security and want to sell it, you will receive the bid, the lower of the 2 prices. If you do not own a security and you want to buy it, you will pay the ask. The difference between the bid and the ask is called the spread, and that's what the broker earns for doing the transaction. All right, so you have a bid and an ask. If you want to buy a bond, you're going to pay the ask. If you want to sell a bond, you will receive the bid. U.S. federal Treasury bonds have a unique pricing system. Since you are selling the bond, you will receive the bid of 99.5. The 99 stands for 99% of par value, which you know is $1,000. Okay, so that would be $990. To use the 0.5, divide 5 by 32. That equals 0.15625. So 5 divided by 32 is 0.15625. So you tack that on just to the right of the 0.99. So let's get rid of this. So 99.5 on a Treasury. 99.5 equals 0.99 and 5/32, which goes right here, which is 15625. 15625. You tack it on right here, and that is 5 divided by 32. That's what the 0.5 is. It's 5 divided by 32. Congress and the market came up with this. Don't ask why. Then you multiply that by $1,000, which means you simply move the decimal point over 1, 2, 3, and this bond, you will receive $991.56 if you are selling the bond. All right. What price will you pay if you want to buy the bond? Well, it's 99.5 to 99.6. If you want to buy the bond, you're going to pay that. If you want to sell the bond, you're going to get that. So that would be 0.99 and 6 divided by 32, which is 0.1875 times 1,000, which means you move this over 3 decimal spots, 1, 2, and 3, and it is 991.875. So the difference between this and this, which is 31 cents, 31 and a half cents, is what the dealer gets. 31 and a half cents per $1,000 bond that is traded. All right, a corporate bond has the same price as what will you pay to buy a corporate bond. So 99.5 to 99.6 if you want to buy it. These stand for a corporate bond, treasury bond. For a corporate bond, this is 99.5% of par to 99.6% of par. If you want to buy it, you're going to pay 99.6 times 1,000. Let's go ahead and move the decimal point here. And you're going to pay $996 for a corporate bond. If you're going to sell it, it's 0.995 times 1,000 equals $995. Okay, that's all. That's corporate bonds are much easier to do. All right. What price will you receive? Let's see. No, we already did that. What 4 components are factored into interest rates? What are the 4 components of interest rates? First, the amount of time that your money is going to be locked up. Second, inflation. Third, credit risk. And fourth, the demand for money. The longer the time, all things being equal, the higher the interest. The higher the inflation rate, the higher the interest. The higher the credit risk is the risk that the borrower will not repay, the higher the interest. And the higher the demand for money, vis-a-vis the supply of money, if demand goes up, interest rates go up. The yield curve currently has a positive slope. What does this mean about rates on short and long-term bonds, about Federal Reserve policy, and about the economy? Okay? The yield curve is a graph that has term to maturity in years on the x-axis and interest rates on the y-axis. So let's just draw one. Get rid of this real quickly. All right, the yield curve. So we have IY, the market rate of interest, 0, 1, 2, 3, and 4%. And then we have years till maturity. And this might be 1, and this might be 30. Okay? Positive yield curve means that the yield curve has an upward slope. So as time goes on, you pay or will receive a higher interest rate. Short term, lower. All right. So the shape of the yield curve tells us about the Federal Reserve, about inflation, and about the economy. So a positive slope like this means the rate on short-term bonds is lower than the rate on long-term bonds. This implies that the Federal Reserve has an accommodative or easy monetary policy. It means that the Fed is buying bonds, not selling bonds, and the economy is growing nicely, and there is a little modest inflation in there. That's what this curve, this positive slope, tells us. What is an inverted yield curve and why is it important? An inverted yield curve is when rates on shorter term issues, bonds, higher than rates on longer term bonds. Well, who controls short term rates? The Fed, the Federal Reserve. So what this tells us is the Federal Reserve has been selling bonds back to the banks, pulling money out of the system in order to drive interest rates up, in order to slow the economy, in order to pressure inflation down, okay? And so we're heading into a recession. Heading into a recession. So investors anticipate slower economic growth, lower inflation, so rates on longer-term bonds will fall. Rates on shorter-term bonds have risen, and this implies a weak economy, possibly a recession, is imminent. So I think that is it for homework number 6, and we'll take a break and move into chapter 8. Peace out, shalom.